Let's take us through the setup here. Are you optimistic about the future of the markets in the next 3 to 6 months, given the fact that we're so close to record highs?
Hi, Dom. Thanks for having me. Well, the market had a very sharp day yesterday, and it reminded us of the end of August. And remember, we had a month of September down 3.8%, where the Nasdaq underperformed, and stocks like Apple, Amazon, Facebook really took a hit after months of leading the charge. What I think we saw yesterday was a return to the Nasdaq and the type of names that sort of brought us here, because the market wants a stimulus. The market seemed to expect yesterday that there was going to be positive news from Washington, either this administration or the next administration, and that we were going to get that because GDP and consumer spending really needs that boost from the government to propel it forward. And it felt that the market was saying, we're going to get that. That will help GDP keep growing. After the minus 31% in the second quarter, we're going to have a big plus 30% type number in GDP for the third quarter. Have to keep that going for the market to move higher. And if it's going to move higher, it's hard to see that technology stocks cannot be a big part of that process.
I mean, the path of least resistance, Carrie, arguably has been to just go back and fall back on mega cap technology. It's been the prevailing theme for markets over the better part of the last decade since the great financial crisis. But there was so much talk about this rotation that somehow underperforming value was going to kind of broaden things out, and it was going to help lead the next leg higher and get this market a little bit more broad-based. It's not really happening, though, or is it?
Well, it's a very good question. And if you look at the numbers, here's what you'll see. Year to date, through yesterday, 38% of the 500-ish names, it's not quite 500, in the S&P 500, only 38% were ahead of the market for the year. But if you looked at from September 1st to the present, the number is double that. It's more than double. It's 77% of stocks have outperformed the S&P, meaning it's a broadened market. It has broadened. So it's not just technology stocks. We have added industrials and some healthcare, very few financials, but there are more consumer names, consumer discretionary names. It's not just the big five or the big 10. You've really had to see more names participate for this market to move higher in a sustainable fashion. And that has happened over the last month and a half. We'll see if it will continue. It can't happen without the technology stocks participating. That's the point I'm trying to make. It's very hard for the market to move into new high territory without, you're seeing Apple, Amazon, Facebook, Google, those names part of it, because they still represent the growth engine of this company's economy.
All right, so that's easy. I consider those easy picks, right? I mean, to go into FANG names and everything else. What exactly are you as a portfolio manager putting on your shopping list that is not FANG?
Yeah. Well, the stocks that we've been buying in the last few weeks when the Nasdaq slid were names like PayPal and CRM. Those have been big stocks, don't get me wrong, this year, but they really did take a hit in September. We bought Boston Scientific. They had very little business when hospitals were closed for discretionary surgery. It started again. Waste Connection is the name we've added. Even Baba, the Chinese digital company. Remax, which is the real estate brokerage firm. And Blackstone on the financial side. We've been adding those over the last couple of weeks, and we think there's quite a long runway there as well.
And Carrie, before we let you go, it's obviously a huge day for Amazon and Apple because of Prime Day and everything else, but it's also a big week for the financials. Those banks have underperformed for so long. Is there anything that we can see out of these big bank earnings reports this week and next that gets you fired up about the financials?
Oh, gosh, the poor financials. If you were to look at the perfect storm to hurt them, you would have very low interest rates, a recession, a pandemic, and problems with real estate and city, real estate leases that they have to deal with. So I think that we have to listen to whether they've had many defaults, how they're seeing their portfolio, what they're doing with loan loss. Interest rates are moving a little bit higher. It would be nice for them to get something sustained above, 0.7% on the interest side. We don't own any of those big banks, but we're definitely listening to them because they point to what the economy will look like over the next 12 months.
Shepard Smith here. Thanks for watching CNBC on YouTube.